morning! Let's talk about something that might sound a bit complicated at first, but I promise we'll break it down together. Imagine you've got a stock you're quite fond of, one that's done rather well for you over the years. You're proud of it, but lately you've been feeling a tad nervous. The market seems a bit wobbly, and the thought of losing all those lovely gains is keeping you up at night. What if I told you there's a way to protect your cherished investment, almost like hiring a personal bodyguard for your portfolio? This is precisely where a clever little strategy called the collar comes into play. It's a way to put a protective fence around your profits without having to sell your shares just yet. Think of it like this. You're trying to find a balance. On one hand, you don't want to miss out if the stock suddenly shoots for the moon, but on the other hand, you absolutely want to prevent a catastrophic loss if it decides to take a nosedive. The collar strategy is designed to do exactly that. Before we can build our collar, we need to understand the individual bricks. First and foremost, this strategy is for people who already own at least 100 shares of a particular stock. This is the foundation of everything. You've held on to these shares because you believe in the company long term, but you're just looking for some short-term protection against volatility. At its core, the collar is an options strategy that involves 3 parts: owning the underlying shares, buying a protective put option, and selling a covered call option. Now let's talk about the protective put. Buying a put option gives you the right, but not the obligation, to sell your shares. That sale happens at a predetermined strike price before expiration. It's like buying insurance for your stock. The final piece is the covered call. When you sell a call, you sell someone the right to buy your 100 shares at a specific strike before expiration, and you receive a premium in return. Own the shares, buy the put for protection, sell the call for income. That's your collar. Let's get right to the heart of it. What's the trade-off here? The fundamental principle of the collar strategy is a simple exchange. You are consciously deciding to limit your potential for massive, unexpected profits in order to secure robust protection against significant, painful losses. When you sell that covered call option, you are effectively putting a ceiling on your gains. If the stock price skyrockets past your call's strike, your shares will likely be called away. You'll miss further upside, but lock in profit up to that level. By purchasing the put option, you establish a firm floor beneath your investment. The premium you receive from selling the call can offset the cost of the put, sometimes creating a cashless collar or at worst a small net debit. This means you can often set up protection for a very low cost or even collect a small net credit. The trade-off is you miss explosive rallies, but you gain guaranteed downside protection. It isn't for speculators chasing wild profits. It's for prudent investors who want to protect what they've already built. Most importantly, it allows you to sleep a little sounder, knowing you have a plan no matter which way the market winds blow. So, when does it actually make sense to put a collar on one of your stocks? The most common reason: you're sitting on a significant unrealized gain. Maybe selling would trigger a large capital gains tax bill, or you still believe in the company's long-term prospects. Another scenario: heightened uncertainty, an upcoming earnings report, central bank meeting, or geopolitical event. Rather than guessing or selling early, you can apply a collar to ride out the storm while keeping some upside. Collars are also useful for investors approaching retirement or those with low risk tolerance. Preservation over speculation. If one stock dominates your portfolio, perhaps from employee stock grants or stellar performance, a collar can temporarily hedge that concentration risk. It buys you time to plan diversification without rash moves. In short, sitting on large unrealized gains, expecting short-term uncertainty, or de-risking before retirement. These are ideal times for a collar. It's a mindset shift from accumulation to preservation, a practical, measured response to an uncertain market. Temporarily hedge your big positions and protect the wealth you've already worked to build. Now let's consider the weather forecast for the market. Is the collar best for a sunny bullish day, a stormy bearish one, or just a cloudy neutral afternoon? The honest answer is it's most effective in a specific blend of conditions. Ideal environment: cautiously bullish or neutral to slightly bullish short term. If you're extremely bullish and convinced the stock will soar, a collar may not be right. It caps your upside. Similarly, if you're deeply bearish, a collar isn't the most direct strategy. Selling the shares or buying puts might be more efficient. The collar is for the investor who believes the stock may hold or climb a little, but worries about a possible 10–20% correction. It allows modest participation up to your call strike while insulating you from a scary drop thanks to your put. It's the strategic choice for the thoughtful investor who sees both opportunities and dangers ahead. Neutral or cautiously bullish markets, that middle ground where prudence and optimism meet, is where a collar shines. It's a measured response to an uncertain world. All right, let's move away from theory and get our hands dirty with a real-world example. We'll use a company that has been on a phenomenal run, NVIDIA, ticker NVDA. Let's imagine it's today, the 31st of August, 2025. You bought 100 shares of NVIDIA some time ago, and now you're sitting on a substantial profit. The stock is currently trading at a hypothetical price of £130 per share. Your 100 shares are therefore worth a tidy £13,000. You're thrilled, but also a bit nervous the tech sector could see a pullback. You decide you're comfortable with a floor at around £120, and you'd be willing to sell if the shares rise to £140. You pick contracts that expire in about 3 months, a clear time frame to re-evaluate. To protect downside, you buy one put contract at the £120 strike. If the put costs £4 per share, that's £400 for one contract covering 100 shares. Now that we have our chosen stock and options, let's walk through the exact steps to open the collar on your brokerage platform. Most modern trading platforms make this straightforward. Step 1. You must own at least 100 shares of the underlying stock. In our case, NVIDIA. Step 2. Buy the protective put. Navigate to the NVDA options chain and select your chosen expiration. Locate the £120 strike and place a buy to open for one contract. Confirm the order. The £400 premium is debited from your account. Step 3. Sell the covered call at the same expiration date. Place a sell to open for one contract at £140, and you'll see the premium credited to your account. Here's the math. Put cost £400, call income £350, net cost £50. Your protective structure is in place for the quarter. Mark your calendar. You'll re-evaluate at expiration in 3 months. You've defined a floor at £120 and a ceiling at £140. For a mere £50, you've guaranteed your £13,000 position won't fall below £12,000 for 3 months. So, your 3-month expiration is approaching. What happens next? There are a few ways this story can end, depending on where the stock price is. Scenario 1, the stock stays within your collar, say £135. Both options will likely expire worthless. This is a great outcome. You keep the shares and your protection cost was only £50. Scenario 2, the stock rises above your call strike, say to £145. Your call will be exercised and the broker will sell your shares at £140. You exit for £14,000. You missed extra upside, but you locked in the profit you specified. Scenario 3. The stock falls below your put strike, say to £110. Your put is valuable. You can exercise the put to sell at £120 or sell the put itself for profit. Either way, you protected capital as planned. Have a plan for each outcome. Let options expire, allow exercise the put, or roll/reopen a new collar. The key is you were in control and you executed a deliberate risk management plan. Decide whether to reapply protection, let the position go, or use proceeds for diversification. As we wrap up, I hope you can see the collar isn't as intimidating as it first sounds. It's a practical tool for anyone with a stock they love but a market they're wary of. Mechanics recap. You own the shares, you buy a put as insurance, you sell a call to help pay for it. In our NVDA example, you paid a tiny net cost of £50 to protect a £13,000 position for 3 months. Ideal when you're sitting on large, unrealized gains, feeling cautiously bullish, or facing short-term uncertainty. This is preservation, not speculation. Protect what you've already built. Next time a stock has had a fantastic run, don't just cross your fingers. Consider a collar. It's sophisticated yet accessible, a way to take control and manage risk actively. Manage risk, stay invested for the long haul, and avoid sleepless nights. Be a smart, proactive guardian of your assets. A comforting thought. Thank you for joining me this morning. Good luck with your trading and see you next time.